what did you like in this world now, in this new era that you started for yourself?
I think goodness, there's a lot to like. I think the first thing is the fact that there are so many amazing people out there. I have been, and again, I'm not unique in this aspect. I've just been incredibly lucky once again to have met some extraordinary people through this business. The level of I guess, camaraderie. I mean, obviously, there's, everyone has their stories that are not necessarily positive, but overwhelmingly, what I found is that the industry is full of good people. And the ability to form new and exciting relationships, and really, every day brings up something new, and it's a really exciting time. I think this industry is changing so much so rapidly, and I'm just blown away by the people with whom I meet just about every day, who have levels of understanding about various things that I simply don't. And I just love speaking with them and learning.
Our guest for today is Ian Drewe, a former corporate attorney and investment banker who spent more than 3 decades structuring and raising hundreds of billions of dollars in investments for some of the largest real estate investment trusts and funds, including Morgan Stanley. Today, Ian works closely with family offices and institutions, helping them identify well-structured, risk-mitigated investment opportunities. Ian, welcome to the Wealth Vibe Show. I'm super excited to have you with me today.
Hi, Vinki. Thank you. And look, it's great to be here. Thank you so much for the opportunity.
Of course, I'm looking forward to hear all about your journey and learn from your experience. So, everyone who's listening today, our topic for today is what family offices really look for in an investment. And as you listen, think about this question. If a family office look at your investment opportunity today, would it pass their first level of scrutiny? But I'm going to tell you this, by the end of the conversation, you should have a clear understanding of how family offices and institutional investors evaluate deals, structure deals, or decide where to deploy capital. So, Ian, you have spent decades in structuring and raising capital for some of the largest institutions in the world. From your perspective, what is the largest misconception investors have about family offices and how they make decisions?
Well, I think if it really depends on whose perspective you take, and I think that if we talk about probably the number one biggest shock for those who are seeking capital, either from family offices or institutions, I would have to put the level of ownership that family offices and institutions require for taking the bulk of the risk of a project. And I see this over and over and over again. And I guess if I keep seeing this, then perhaps that's on me that I'm not explaining it or managing expectations well enough. But look, the bottom line is this, and obviously there's an exception to every rule, but I'm pretty comfortable in saying that if you have a family office or an institution that is being asked to fund anywhere from 70 to 90, sometimes 100% of the project, if you're extremely lucky, then they are going to want two things. They are going to want as much control as they can get within reason, and that probably is a variable that is the greatest amongst the particular investor. But I think what is common is the amount of ownership and the amount of the proceeds that they want for taking on the majority of the risk. And so what I guess see time and again is some degree of shock from my kind of sponsor clients, my developer clients, at the ask from family offices and institutions, it's different to retail. And that's the trade-off. That's one of the first trade-offs that you should appreciate is if you are going to seek family office funding, if you are going to seek institutional funding, then you are going to have to be prepared to give away more equity than you will, all else being equal, with a retail investment.
Okay, so I understand. So when family offices, they are evaluating a deal, they're looking for two things, the maximum control and maybe maximum ownership on the deal because they're bringing in the bigger chunk of the money on the table, correct?
Well, they're taking the risk.
Exactly.
And so when you think about it, it's all else being equal, pretty fair that if they're being asked to essentially take, certainly in financial terms, the vast majority of the risk, then they are going to want to be compensated and protected accordingly. And obviously that's, can range enormously on a deal by deal basis. But I think that should be that axiom is pretty true.
Okay, so in your experience, what separates the deals that attracts the institutional capital versus the one they don't even want to look at it, like getting the serious attention versus, yeah.
Yeah, I think again, the overarching concern for a family office and an institution is not necessarily the return on the investment, but the protection of their investment. A family office wants to know they're going to get their money back. An institution wants to know it's going to get its money back. And so if you start with kind of the understanding of that concept and work backwards, if I had to generalize, family offices and institutions will invest in deals where they can see a very clear path for that happen, for their money to come back. And that in turn, I think, probably reflects on three things. At the risk of stating the obvious, they look very, very strongly at the operators. And we can talk a little bit more about that in a second. They look at the structure. And so I've seen too many deals fall over where the sponsors, and I don't want to sound like I'm giving the sponsors a tough time here. It's just it just is that the sponsor needs to be willing to facilitate a structure that enables the family office to get their money back with a certain degree of certainty and timeliness. And then obviously the third is the strength of the transaction itself.
You brought up a really good point because I think most operators, I would say, the retail operators, they mostly focus on the projected returns. I think that's what the selling point is. And you you said, no, minus this, because family offices or the institutional investors, they look more at structure. So what kind of structure? So guide us, take us through that journey. You learn from your experience, decades of experience. So you will know by looking at a deal whether it's structured according to their parameters or no.
Yeah, I think that if you were to, again, speak very generally, family offices often and institutions will structure a deal where essentially they will get their money back prior to the sponsor and other interested parties being paid out. And that sometimes is a shock to the sponsors. They want to get, they want to get paid. And look, they do get paid through a myriad of different fees and other mechanisms. But if you are looking at the splits as between the sort of the sponsor and the investor, more often than not, a family office will say, we want our money back prior to you guys getting paid anything on the sort of GP side. And obviously that's very different from the structure with a retail investor where again, depending upon the structure, you could have something as simple as just a very predetermined split where assuming, the cash flow is sufficient, the retail investors will get a return, the GP will get a return. Here that will happen, but it will occur mostly after the family office or the institution have gotten their money back.
Interesting. And you said they are more about the protection and they wanted to make sure that they have the risk mitigation plan in place as well, right? Because they wanted to look at the deals that can be managed easily. That's the reason I think they wanted to have a little bit more control on the deal so that they have the decision-making authority right there. So if you can shed some light on that as well.
Yeah, I mean, look, smart family offices and institutions don't want to manage the deal on a day-to-day basis. So I don't want to come across as saying that, they basically want to take over the deal and run it. Most family offices will have some kind of step-in provision if things go, horribly wrong. But also, family offices are basically investing in you as when I say you as an individual, as a sponsor group, and then of course the operator if that's a third party as well, and so they will do their due diligence to the nth degree and wouldn't invest if they're not comfortable with that. So essentially, they are saying, look, we believe in you as a sponsor group. Most will say we don't want to because that's not their day-to-day expertise, and they recognize that. But then the flip side is that, as I said, they need to make sure that they structure not only the cash flows, but the step-in rights if things do go wrong, to be able to come in and sort things out if they need to. Obviously, they hope that's not the case.
So how do they analyze the risk? Because I think, okay, I wanted to make sure that that fits my criteria. Is there any specific formula or some kind of standards that they have set that they follow in order to make sure, okay, that's what I wanted to do before I commit?
Well, I mean, obviously, every investor has their own set of criteria, and it's very
Exactly.
difficult to generalize. What I will say, and this also applies, I think, to retail investors as well, is one of the areas again that you would have think would be reasonably obvious, but it sometimes with certain, and we have wonderful. Again, I don't want to sound like I'm in any way, shape, or form denigrating or excuse me. Um, or kind of bashing sponsors who are seeking capital because we've seen some wonderful clients on that side of the equation. But sometimes it's difficult for I guess sponsors to appreciate that they need to be able to I guess stand behind not only their own record, which again is fairly obvious, but when we get into the minutiae of things such as model discussions. So, there's two elements here that sometimes catch sponsors by surprise, which is kind of odd, but it's true. It happens quite a bit. You can't, as a sponsor, I don't think that you can essentially divorce yourself from a really clear understanding of what it is, the story that you are telling through the model. And so, if I'm an investor, if I'm a family office, and my return, my cash flow is predicated on a whole bunch of assumptions, then the sponsor better not only know what those assumptions are, but be able to verify those assumptions and make me really confident that
Sure.
those assumptions are credible, and that the sponsor understands and believes them. And it's amazing how often that sort of doesn't happen. Sometimes because these things are, I think, left with perhaps a junior, and some of the senior members of the sponsorship team kind of don't take their eyes off the ball in that sense. The other I guess, element that most family offices and institutional investors look at really closely is the operator risk. And again, this is something that good sponsors are aware of. And that's the fact that you can have the best business plan in the world, you can have the best model in the world, you can have the best story in the world. But ultimately, if you don't have the right person executing that business plan, then the whole thing is academic, and is in turn an extremely risky investment. And I never think that, I think some sponsors get a little bit put off when there is some pretty, stern due diligence done on the operator, and then on kind of the sort of contingency plans if the operator falls over for whatever reason. And that, to me, is one of the biggest risks of any investor today, is having an operator that isn't able to execute the business plan, or I guess, yeah, either isn't able, or for whatever reason falls over, breaches a contract, and then option B and C comes in place. And so most sponsors are aware of that, but that tends to take a lot of time in terms of the sort of due diligence discussions, which is fair enough.
Yeah, I really like it, how you give this very elaborated answer and then just very simplified approach. Basically, what it boils down to is just like how comfortable you are in your relationship. So that's what the bottom line is right there, and which most people miss. You cannot really just go to somebody and say, okay, here's my deal, give me the money. That never happens, right? It takes years to build that kind of relationship with somebody.
Absolutely, and this is one of the things that I had to learn. It took me a while to learn it as well. When I was very fortunate to have spent the majority of my career working with institutions, and so it wasn't so much when I went to pitch a potential client. They weren't worried so much about who on earth Ian Drewe was. It's really whose hat was I wearing, what institution was it, and I guess the merits or otherwise of the particular structure that I was pitching at the time. But Vinki, you're 100% correct. In the world of the family office, I guess the strength of the relationship and the reputation of the individual or firm involved is everything. And again, that's fairly obvious. That nothing changes there.
Okay, I would like to tap into your experience. So let's go back in your journey. When you started, how did you get started? And also, given your experience as an attorney and then in Morgan Stanley and multiple institutional level investments that you have done or raised for, I would love to learn from you. How did you set yourself up on this path?
Goodness. Well, unfortunately, many, many years ago, I started out life in Sydney, Australia as a corporate attorney. And it was I was incredibly lucky because it was a wonderful, wonderful time for anyone involved in the investment community in Australia. Australia had essentially just deregulated most of its, I guess, banking laws. And what that meant is that a flood of overseas banks and attendant service companies came to Australia right around the time that I was starting, which again was just sheer good luck on my part. So we were really from day one involved in some amazing transactions by virtue of what was going on. Our entire market opened up. Look, I was a lawyer for around I think 3 or 4 years, and then I decided that I wanted to be on the other side of the table. So I jumped ship and I joined a German bank, which again was incredibly fortuitous for me. I didn't fully appreciate the position that I had been placed in. They were relative newcomers to Sydney. They were looking to build out an investment banking team. They had a massive balance sheet and a huge appetite. And we were just in the right place at the right time. So Australia again was oddly really at the forefront of public-private partnerships, and so we did some amazing deals on the investment side across a raft of assets, real estate, infrastructure, energy. All of these deals, I think most Australians cut their teeth on. I was no different. I was in many ways a walking Australian cliche. The bank with whom I was at wanted me to go to Frankfurt and work with head office there to try and replicate what we were doing in Australia, potentially throughout Asia. So off I went, ostensibly for 12 months, and well, I'm still going in the Northern Hemisphere. I moved after my year in Frankfurt. I left that bank, which ultimately got swallowed up by another German bank. Moved to London, continued on doing what I was doing. I was very fortunate again to work with teams and institutions that essentially expanded our mandate from the types of financing that we were doing beforehand into some really amazing cross-border structured financings, which ranged from the very simple to the very complex. We were able to, I guess, do some financial engineering that enabled many businesses and assets that otherwise at the time wouldn't have got funded to be able to get funded. And we had a lot of fun. We were very proud of what we did. That all went swimmingly until 2008 came along, and that was the end of structured finance as we knew it. And look, very briefly, because I've been babbling way too long, we moved, my family, my young family and I moved from London to New York. I then took up a post in Hong Kong. We were there again with the intention of being there for a year, possibly two. We were there for 7. Recurrent theme in my career. And then I moved back to New York with Morgan Stanley in I think 2017. Retired from banking in 22. Formed my firm, soon to become Avoka Capital, and here we are.
Wow, quite a journey.
Yeah.
Wow. And the funny thing is, I come from a banking background too. I was with the financial institution for 20 years myself,
Oh
but I
wow.
was I was on the IT side of the house. But let me ask you this now. So when you transition into venture capitalist or as a venture capitalist, what was that journey like? Was that easy transition coming from the financial world and now being a venture capitalist?
No, I wouldn't say it was easy, and it was Vinki. I got the biggest shock when I thought I think I retired. I lasted 2 nights when Morgan Stanley called us back into the office, and I resigned sometime around 3 or 4 in the morning on the second evening that I was there. And I thought, you know what, I'm gonna go and work for myself. It's something that I always wanted to do. I would have more autonomy, more ability to pick and choose my clients, my industries, the transactions with whom I work. But what I didn't appreciate was how incredibly well off I had it working with institutions. So all of the support that I enjoyed for, I guess, in banks, the better part of 25 years, whether it's through legal and compliance support, IT support, account support, all of the back and middle office functions, where really I had everything done for me. Now I didn't. And all of a sudden I had to do that on my own. And I tell you what, that was a bit of a shock. So I wouldn't say I necessarily enjoyed that part of it, but we got through it. It's all about getting the right people, surrounding yourself with the right people, getting the right teams. And once I kind of got through all that kind of stuff and got the firm up and running, it's going well.
So you told us what you didn't enjoy, right? Starting from ground zero again, setting all the systems and processes. I can understand that takes a lot of time because in the corporate world, it's kind of done for us already, right? Kind of deal. And you're starting your entrepreneurship journey is like starting from ground zero again and building everything, brick by brick. It's hard. And a lot of people don't like, and I didn't like it initially, but I think sometimes, it's just like comes through you because you have been there, done that already, right? So now let me ask you this. What did you like in this world now, in this new era that you started for yourself?
I think well, goodness, there's a lot to like. I think the first thing is the fact that there are so many amazing people out there. So I have been, and again, I'm not unique in this aspect. I've just been incredibly lucky once again to have met some extraordinary people through this business. The level of I guess, camaraderie. I mean, obviously, there's, everyone has their stories that are not necessarily positive, but overwhelmingly, what I found is that the industry is full of good people. And the ability to form new and exciting relationships, and really, every day brings up something new, and it's a really exciting time. I think this industry is changing so much so rapidly. I'm just blown away by the people with whom I meet just about every day who have, levels of understanding about various things that I simply don't. I just love speaking with them and learning. So really the relationships, the ability to, which is what as I said earlier, what drove me, one of the reasons why I retired from banking was I did want more of an ability to choose with whom I worked and what I did. And so, that's been very much a thing. It's been brilliant. I've thoroughly enjoyed it since I went out on my own.
That's why they say your network is your net worth, right? So take us,
Absolutely.
yeah, take us through that journey, when you build this strong relationship with all these family offices, because I see you everywhere, and you're a well-known name in the family offices. So building those relationships is like seriously something extraordinary, getting their trust and kind of thinking like them and being part of that clan. So take us through that journey. So let's pick your brain on that, learn something from you.
Yeah. Okay. So the first thing you've got to know about family offices is that it takes time. And the family office world is very different to the retail world. It's very different to the institutional world. Family offices have, I think, a different set of rules, and I think that everything is drawn by the fact that again, it's at the risk of generalizing. Family offices, people are often entrusted at investing the earnings of what their forebears have done, and that's a pretty serious level of responsibility. And so, with that, I will say that the family office world is not necessarily an easy one to crack. You have to be really persistent. You have to try a multitude of different things, and I've certainly done that. So, I took a very institutional approach when I first started to look at meeting and working with family offices. And by institutional approach, again, a lot of the methods that I used that worked for me as a banker simply didn't work as a family office. You need to essentially establish the relationships, and this sounds pretty weird, but it is, and a little bit mysterious, and it's not meant to be, but eventually you'll find the right people, and when you find the right people who will introduce you to the family offices, then you need to be really ready. And that's the more so, I think, again, than with institutions. So a family office is or a representative from a family office is interested in you as a person. And don't get me wrong, institutions were as well, but as I mentioned before, they're looking at the institution with whom you are with and the structure that you bring, and they're going to kind of analyze that on your own. The family office is going to look at you as an individual, look at your experience, and you don't have a huge amount of time, so you need to have your pitch, if you will, really, really ready, refined, and it's got to be right. And it took a lot of time and a lot of working with experienced people in the field to get that right. I don't know if I've got that right, but eventually, once it kind of clicked, then it happened. And I've been very, very fortunate to now have relationships with some amazing family offices, and very much looking forward to building with that. And I thoroughly enjoy it.
Share with me your first relationship when you're going through this relationship building, your first deal with the family office or your first relationship with them. How did you approach them? What did you exactly do to establish that?
I'll tell you what. So when I first started to look to meet family offices, I was not approaching it the right way. I was approaching it in the manner of a banker approaching another banker, and that didn't work. So I was and there's a theme here, isn't there? There's a lot of luck. I was lucky in that I had a very close friend, not had, still do. And so that friend was able to introduce me to a family office around the same time that I started to work with some people who had or have more of a history with family offices, and really explained to me, took the time to teach me how to relate to family offices, which is a very, very different approach and a very, very different skill to that I had been using in my career previously. And so once I had, and I was again very lucky that the two kind of happened in parallel. So with the help from, I'll call them my consultants, and the luck that my friend was able to introduce me to a family office that actually was interested in hearing about what I've done and what I could bring to the table, that I guess set me on the path to where I am today. But it wasn't easy. There's a lot to learn about how to speak with family offices, how to position yourself, and it wasn't obvious. As I said, I had to learn, and hopefully I'm better at it than I was, but we'll see.
So what was that skill or approach that he taught you? Can you share with us? Like a little sneak peek.
Yeah, I mean, I can only, I think, I wasn't particularly good and you've probably seen this from my from our discussion. I wasn't particularly good at getting to the point and at really addressing why a family office would want to speak with me. So
Yeah.
when I was a banker, I would not talk about myself. I would talk about, I don't know, the virtue of what I thought I was bringing to them, and 100 different things. But I wouldn't basically appreciate that I had about 15 to 20 seconds to try and A, get a family office comfortable, and B, give them some indication that there may be some merit in them allocating a certain amount of time to trying to understand who I was, what I could bring, all that kind of good stuff. So it was really basically selling myself,
Transactional.
which I really hadn't had to do before. When you've got an institution behind you, you're more selling the institution and the
Mhm.
product. So they kind of gave me an understanding of how to do that, which at the time I was really, really uncomfortable. It took me a long time to get that right, because it wasn't my natural thing. It wasn't what I had been doing previously. So yeah, it was a process.
Yeah, I think you are right about that because it's like they want like really more in-depth relationships, like wanting to know you who you are, not the transaction. Because I don't think they will need transactions because they have so many transactions on their table already. It's
Yeah.
like, like it's a pile that they have go through versus like who's gonna stand out is just like who's genuine, like who are you before what you're gonna bring me kind of thing. I think that's what I'm gathering from this conversation. But thank you so much for sharing that.
When you think about most family offices, I guess must get tired. A, because you're right, they get God knows how many transactions come through their inbox every day, but equally as I guess annoying, for want of a better term, for them is that they have people trying to get their money day in, day out. And there's only 24 hours a day for a member of a family office. And so they really need to be incredibly diligent on how long they spend on any particular person, whether it's worth their time. So you haven't got that much time to kind of get to the point. Some people are really good at it. It comes naturally to them. Some people aren't necessarily naturals at it. And as I said, it's a skill which took me a surprisingly long while to get right.
That's good. So with now AI coming into picture, you think how family offices are responding to it? Are they looking at just like to bring those tools in-house, or how they're basically evaluating the relationships or the due diligence process, or what is changing in that arena?
Well, I mean, look, the one caveat is that when it comes to any form of technology, I am notoriously bad at it. So my friends who used to work with me, there was still many, many years ago, and this doesn't help me in any way, shape, or form, but I'll tell it anyway. I thought that the bank's entire computer system had blown up, and I had to get what I considered to be the most important document out in the history of the world. Turns out that my computer wasn't switched on. So that's the level of person. So anything that I have to say about AI comes with an enormous caveat. I think that not so much on the operating side. Look, family offices, I suspect, and I genuinely haven't spent much time discussing this with them. But I actually think that it's of more interest to them on the investment side, because it's really changing not only the landscape, but AI is changing how every other business operates. So even in real estate, it's incredible now how it's changing the way that we approach valuation of land and opportunities surrounding land, and the obligatory data centers, and the in real estate, things are changing at an exponential rate. I think because of AI and everything surrounding it, and I think that family offices, like everyone else, are having to grapple with that. Probably more so than how it's affecting the operations within their own business would be my response to that.
Yeah, the reason I ask is because I do see a lot of conferences, a lot of things happening in real estate, but the AI is the main thing in there. So I wanted to see how they are responding to this evolution. And one last question, for people who are listening to this podcast and they're looking to build relationship with the family offices, so how should they approach, a piece of advice that you wanted to give them?
I would say your best bet, and this is the way that I worked, is that there are people and there are firms that are super connectors, and if you really truly want to spend the time, money, and resources to meet with family offices, it's very difficult if you are not a family office yourself, or don't have pre-existing relationships, to really get connected. And so, I realized that that was the case. And so these consultants that I talked about, not only were they able to introduce me to, a number of family offices, but as I said before, they actually, and this is probably the most critical component, it's almost like going to finishing school. And I can't stress this often enough. They taught me how I needed to approach and communicate with potential family office relationships to enable me to make those relationships, because one without the other doesn't work. You need both, and it's very difficult for it's not impossible. People have done it, but I would suggest that you speak with firms that are experts in this field, and spend the time, spend the money, spend the resources, because it's worth it.
Okay, so I lied about the last question. I have a follow-up question for you.
That's all right.
So once you build a relationship with the family office, how do you nurture that? Because they don't want it to hear from you every week, every month, and if you do not talk to them for 6 months, they might forget about you. So how do you keep on nurturing that relationship?
I tend to what I tend to do is family offices like to hang out with other family offices, and family offices are generally pretty wealthy. So they like to do things that wealthy people like to do. And so if you want to nurture relationships and make family offices want to spend time with you, then I try to throw events, nothing on the scale that you're doing, Vinki, but much smaller events that I think will be interesting to my existing and potential family office clients. So in that sense, it's attractive to them because hopefully the activity or event is attractive, but also the fact that they get to meet, if they haven't already before, other family offices in the field, which is of interest to them. And so that's kind of what I like to do. And in that sense, it's not dissimilar to the way in which we used to entertain on the institutional side. I think that's sort of is a generic appeal. So that would be my secret. And you're absolutely right. They don't want to hear from me every week or 2 weeks.
That's true, unless you have something really important to share with them, it's kind of unnecessary. That's the way I was thinking about that. But this brings us to our rapid fire round, like I told you before. So it's kind of fun exercise. I'm gonna ask you 5 questions. You're gonna be answering it in one word or one sentence only. All spontaneous, whatever comes to your mind first. Are you ready?
I am.
Okay. So first question is, are you more of an early riser or someone who thinks best at night?
Oh, early riser.
What daily habit keeps your mind sharp and focused?
My walk.
What book most influenced your thinking about investing or business?
Oh my goodness. Um, 7 Daily Habits.
When you need clarity on an important decision, where do you go mentally?
I go mentally where I go physically on my walk. That's where most of my thinking is done. Oh, more than one sentence.
I think that's a good one. And what is your wealth vibe?
Consistency.
Oh, I love that. Oh my God, this is such a great conversation. It's like more than I expected. Thank you so much, Ian. So, but before we wrap up, can you share with our listeners how they can get in touch with you if they like to learn more about you and your work?
Yeah, sure. So I'm actually in the process of rebranding my company. It's soon to be called Avoka, Avoca Capital. We're in the process of working with our marketing and branding team and all that kind of good stuff. So hopefully in about a month's time, that'll all be you'll see the website, and if you just go to the website again, Avoca Capital, you can reach me from there.
Great. So, to everyone listening, attracting serious capital is not just about presenting a great opportunity, it's about understanding how experienced investors think. And all these family offices and institutions, they succeed at whatever they do is because I think they focus on structure, discipline, and the protection of their assets. That's the most important thing for them. So I think there's a good takeaway into this episode. So stay inspired, stay intentional, and keep building your wealth vibe.
Thanks for tuning in to the Wealth Vibe Show. If you enjoyed the episode, be sure to subscribe and leave us a 5-star review. And don't forget your free gift. Download the Busy Professional's Guide to Real Estate Investing at loombainvest.com. See you next time with another amazing guest and another powerful conversation.